Hello and very good day to all of us over here in this room. Excuse me. And wishing a very good day to all our online viewers via Money Control. I'm Abhijit Roy, co-founder and CEO of Goldenpi, the online platform dedicated to investors purely for their fixed income investments. Now I understand that fixed income investments as a theme probably is diagonally opposite to what you would have expected as a discussion topic today. So please bear with me. I'm sure I would be able to provide some value, some information to you, which will add value to your portfolio in return. So first question, let me ask everybody in this room, how many of us are aware that there are investment opportunities beyond the bank FDs, which we have known since independence? Can I see a show of hands? Wow. I see a total statistic of 3, which gives me the confidence that definitely what I'm going to speak on will add value to the audience here, right? Cool. So today I'm going to take this opportunity to speak to you about lesser known or totally unknown alternate fixed income assets beyond bank FDs, which offer way better returns. I'll take you through those asset classes, the benefits that are there, the process of investment, and the taxation. And at the end, I'll take your questions. So let me lay out some of those assets which are there in the market. Firstly, bonds and debentures. May I request a show of hands once again as to how many of us know or have heard the name of bonds? Cool. It's a slightly better statistic now. The second asset that I'll speak about are NCD IPOs or non-convertible debentures IPOs. Third option would be sovereign gold bonds. Fourth option is corporate fixed deposits and commercial papers as a last. I'm going to cover 4 primary assets over here and take you through the journey. Let me start by giving you a perspective about the overall bond market, right? Across the globe, the entire size of the bond market is a staggering $133 trillion. With respect to that, you'd be surprised that the equity market is close to around $100 trillion. In our country, it's a reverse. Equity market stands at, I think, $3.5 trillion, and the bond market stands at around $2.3 trillion. However, the point to note over here is that it's a very vibrant market which we have in our country and is increasing at a very rapid pace, given the impetus from the regulators like SEBI and RBI, and a strong push from the central government to increase this market so that investors like us can participate. So the first question that one should ask is, why do we look at fixed income opportunities at all, right? And maybe a question before that, why look beyond bank FDs? See, bank FDs has solved a very critical problem in our life. One is giving very good returns of 10 to 11% 10 years back. And a lot of stability, because these are banks, capital is protected. But in the current situation, right, with a host of RBI rate cuts, and even with a little revision that has happened recently, on my traditional bank FD, say an SBI bank FD of 5 years, I would get 6.5 to 6.8%, right? That's very poor. That's literally either just matching the inflation or sometimes even below that, right? So I am actively looking for investment options to diversify my portfolio, which give better returns than this, right? So first option is to get better returns from bank FD, right? Now, I'm sure a lot of us would know that bonds can be used very effectively to pledge for your equity trading, right? That is one of the key advantages as traders that I would encourage everybody to avail. I'll go to the details of that later. Second thing, why we should have fixed income in a portfolio? Because these assets generate a steady passive income which adds to the bank account of the investor, right? Third is, as the portfolio theory says, we should have a well-diversified portfolio. On one end of the spectrum, we have exposure to high-risk, high-return asset classes. On the other end of the spectrum, it should be lower risk, lower returns, so there is a very good balance on the portfolio. Let me begin with the asset classes one by one. First, bonds. What are bonds? They are fixed income securities. In reality, a bond is basically an instrument wherein I have lent money to an entity. It can be a central government, it can be a state government, PSU, PSBs, or corporates. They promise me fixed returns for a defined tenure, and at the end of which I get my money back, right? It's a simple loan instrument that I have given to an entity, and they will pay me. Now, quick look at the benefits of bonds. First, when you have them in your portfolio, right? On investing, let's say you invest in a bond that is yielding 11 to 12%. If you hold that bond to maturity, you are going to get that 12% irrespective of whether the market is going up or down. So you beat the volatility. Second point, when the bond matures, the issuer returns back the capital that you had invested, which means there is strong capital preservation over there. Third, we have already spoken about it, you get better returns than bank FDs. Just to give you a perspective, there are two categories of bonds over here. One, which are issued by the central government via RBI. They are the government securities. How much does a government security yield? A 10-year government bond as of today would be paying around 7.2%, right? Still slightly more than an SBI bank FD. When you look at the other category of bonds, which are issued by corporates, right? There, you can earn anywhere between 8% to 14%, as high as 14% as returns on these bonds. Yeah, and last but not the least, they help you in diversifying your portfolio. Few examples of bonds, and I wanted to point out these specific bonds because they are pledgeable. NABARD, AAA rated stable credit rating, the payment or the coupon payment on this is 8.2%. PFC, AAA rated bond, 7.6%. And Indian Renewable Energy, 7.74%. And they are all pledgeable. Now moving on, before investing into bonds for our portfolio diversification, it's important that we know about the bond terminologies, the basics, right? First point, what is a face value? It is the price at which a bond is issued for the first time by the issuer into the market, right? So let's say, for example, Power Finance Corporation launches a bond, right? And the face value is 1,000 rupees. Coupon rate, that's a very important parameter. Why? Because this is the percentage which determines what is going to be my cash flow that I'm going to get from the bonds, right? And this 10% that you see as an example over here, this return will be on the face value of the bond, not on the market value of the bond. Third parameter is maturity date or call date. Pretty simple to understand. It means the date by which the bond will cease to exist and the issuer will return me back the money. Call date means the issuer has got an option to call back the bonds. If they don't want, they can continue it further. Fourth point, before investing, at a glance, how do I know the risk profile of that bond, whether it's a risky bond or it's lower on the risk spectrum? One straightforward way is to look at the credit rating of the bonds, right? Bonds come over an entire spectrum of rating. G6, they don't need any credit rating because they are issued by the government, and it is accepted that they are not going to ever default. Then comes the actual credit rating spectrum, AAA being the highest, then AA, then A, triple B. This is the spread of investment grade bonds in our country. I must sound a word of caution over here. Credit rating cannot serve as the only parameter to judge the riskiness of a bond, right? You got to look at a combination of other parameters, simple ones, looking at the financials of the company, looking at the management quality, and take a holistic opinion, then go ahead and make an investment. Yield to maturity. This is a very important parameter because this is the one that tells me what is the actual return percentage I'm going to have by investing in the bond. The reason is, once bonds are issued in the market, they start getting traded exactly like equity. So when I go to buy a bond from the secondary market, I will buy the bond either at a premium, at par, or at a discount. So basis the value at which I am buying the bond, my ultimate returns percentage is going to depend. That returns percentage is yield to maturity. So I'll just clarify between coupon and yield to maturity once again. Coupon is the actual money amount on the face value that I'm going to get in my bank account. Yield to maturity is the effective returns that I will make basis the price at which I bought the bond. And last, payment frequency. As it's suggested, bonds have different payment frequencies. So bonds can pay monthly basis, yearly basis, quarterly, or yearly, right? So there's a whole spectrum of payment frequencies that you can choose, right, while deciding to invest in a bond. And as you can understand, that helps you match with your requirement of cash flows. Now coming to the concept of taxation on listed bonds. Firstly, the interest that we earn on bonds, right? This one is taxed as per my income tax slab because bonds are literally considered at the same asset class as bank FDs. And a bank that has an FD also has got a bond, and you'll be surprised the bonds give better returns than banks. Now, if I sell the bond in the secondary market, right, then the question of capital gains taxation comes in. Suppose I buy a bond and I sell it within 12 months. That means I am liable to pay short-term capital gains tax if I make a gain. And how much is that? It's as per my income tax slab. However, if I sell my bonds 12 months beyond my purchase date and I make capital gains, then this is going to be taxed at a flat 10%. Now, I'll just bring your attention to one point over here. There's a popular question that why not debt mutual funds, why pure bonds, right? To my mind, two main things, right? A debt mutual fund is an efficient instrument, I understand, managed by a fund manager. However, retail investors don't look at what is there within that mutual fund. It's a black box, right? Number one. Number two, the returns on debt mutual funds typically are in the range of 4 to 6, 7%, right? And it's a pack of underlying bonds, commercial papers, a lot of securities. When you invest singly in bonds, you have the transparency. Let's say you're picking up a Shriram Transport Corporation's bond. You know, this is the company that I'm choosing, right? Number one. Number two, typically, the returns on these bonds are on the higher side. Second point is, mutual funds don't come with a maturity. Bonds come with maturity. So you don't have to worry about when to sell when the market is going up, right? The bond will mature on its specific date. You will get your money back, right? There's a full transparency and control on this particular instrument. And there was a taxation advantage of investing in debt mutual funds till some time back. But in the last budget, that we had, that indexation benefit which was there on debt mutual funds has been removed. So the taxation on debt mutual funds and bonds, pure play bonds, right, is at the same level, right? So effectively on bonds, you are getting more transparency, more returns, and defined time to maturity. Now I'll come to the process of investment. It's important to understand how do we, invest over here, right? It's a very simple process which has been laid out by the regulator SEBI. You go to an online platform, let's say our platform, Goldenpi, or moneycontrol.goldenpi.com. The process is three-pronged. First, complete your KYC with 4 documents: POI, POA, bank account details, and DMAT. Second, you place order for a bond. Latest regulation says all this needs to be settled via the exchange. So once you place an order, it goes to the exchange, and there are 2 settlement bodies which have been set up by the regulators. First is ICCL, which is a part of the Bombay Stock Exchange, and the second one is CBRICS or NSCL, which is a part of NSE. Their responsibility is actually to enable the transaction in bonds between the buyer and the seller. Right? So online payment happens to ICCL or NSCL. Very same day, the bond units are credited by the seller to your respective bank account. Now coming to the point of pledging bonds for the equity trading, right? It's always efficient to invest in bonds, pledge that to your broker, take the margin money, and do equity trading. Just to give you a sense of what is the kind of margin fund that one can get, if you invest in government securities, the broker is going to give you 98% margin funding on the current value of that bond. And if it is AAA rated bonds, it can go as high as 85%. Now, every month, the stock exchange comes up with a list of these pledgeable bonds, which you can find out. You can invest, right? And then you can use them for your trading. Now coming to the risks that are involved in bonds, right? It's very important that when we are putting our hard-earned money into an asset class, we be acutely aware about what are the risks that are involved in this asset class. The first thing is the liquidity risk. What does this mean? This means that if I'm holding a bond and I want to go out into the market and sell it tomorrow because I have got a family need, all right, or maybe a business need, I should be able to get a buyer, right? And I get the money for my usage. In the bond market, because most investors hold it till maturity, right? There is a disproportionate set of buyers and sellers, unlike the equity market, right? So there, liquidity needs to be built in. On our platform, we have been able to solve it by putting together a lot of buyers and sellers together, along with financial institutions, right? The process is pretty simple. Raise a sell request on the bond that you're holding, put it up for sale, get quotes on it, select the best quote, and sell it out. And once again, the transaction is going to happen through the exchanges. Next risk, default risk. This is a serious risk because this means loss of interest payment or even loss of capital from the issuer on which I have invested my money. So it's very important that when we are selecting a bond, we look at the issuer who has got proper credit ratings, who has got a very good financials, a robust company, and invest in them, rather than putting into something wherein the yields are high, just chasing over there, with uncertainty around whether, I'm going to get my money back. The third point is the interest rate risk. This is a very curious phenomenon. So in the bond market, when interest rate rises, the bonds that I'm holding, their price falls. So at that point of time, if I have to go out to the market and sell them, I might incur a loss. However, the flip side to this is, let's say for example, interest rate is going down. Then in that case, I'm actually sitting at a capital gain. Why? My bond prices are going up, and it becomes beneficial for me then to sell it in the market and make a capital gains. Now coming to the second assets. So this is not really a separate asset from bonds and debentures, but it's like an investment option. The first option that I spoke of were bonds which are available in the secondary market for buy and sell. NCD IPO is a public issuance of these debentures from corporates. This is specifically targeted by corporates, PSUs, PSBs, to raise money from four categories of investors. First, retail, where retail can participate with as low as 10,000 ticket size through a completely online journey, and the regulator has allowed that people can invest using their UPI. And they can invest up to 10 lakhs. Second category is HNIs. So if I'm investing anything between 10,000 to 10 lakh, I am a retail investor. If I'm going to invest above 10 lakhs, the exchange qualifies that person as an HNI. Then there are corporates and then qualified institutional buyers. Four specific categories. So let's say, for example, there is a bond tranche from an issuer that is raising, say, 1,000 crores, right? 25% will be for retail, 25 to 30% for HNI. The remaining will be divided between qualified institutional buyers and corporates. Just to give you two relevant examples at the current time, Aditya Birla Finance is a company whose NCD IPOs are currently running. AAA rated bonds, 8.10% returns. They come with multiple options of payout, yearly, monthly, right, cumulative. And the next one is Indiabulls Housing Finance. Let's look at the process of investment as a retail investor, right? Once again, it's very simple process, right? You got to come to the platform, select the bond of your choice, select what is the payment frequency that you want to do. How much money you want to put in over there. Up to 10 lakhs you can put in, right? So you put those details, put your UPI handle, because that is the way in which you have to pay the money. Once you do that, you have to place the order. What happens after that is, you get a mandate on your UPI app, which you got to accept within 48 hours. Your funds get blocked in your account, and then on the day of allotment, funds are deducted, and the units are credited to your bank, to your demat account. Interesting trivia. The NCD IPO market has been increasing at a very interesting pace post-COVID. A lot of corporates are now swarming into the bond market to raise money from retail. I'll give you one example. NHIT, which happens to be the investment trust of NHI, did an NCD IPO in last year. The total size that they raised was 2,500 crores. Any guess in what period of time the 2,500 crores got over allocated? Any wild guess? One day, 2 day, 3 day. Take a pick. All right, cool. It's half a day. Within half a day, the entire tranche of 2,500 crores got oversubscribed with participation across retail, HNI, corporates, and qualified institutional buyers. There's a lot of inflow of corporates and participation from retail also, which is happening. So last financial year itself, 8,000 crores were raised from this market via 30 NCD IPO launches which happened. Taxation on NCDs, like I mentioned, NCDs are nothing but non-convertible debentures only. So the taxation is essentially the same as it is for the secondary market bonds. Now coming to the third asset. How many of us over here invest in gold as an investment asset class? Can I have a show of hands? Quite a few, actually. And if I may ask, investing in gold, do you do it in the form of jewelry, gold bars, or in the form of, sovereign gold bonds? How popular it is in this room? great choice to invest in sovereign gold bonds. See, the fact is, if I'm making investment into this asset as gold, first thing what I'm doing is I'm paying for making charges. Secondly, there is impurity that needs to be put into that gold to be able to form a jewelry. When I go to sell it into the market, right, all those charges are deducted. So a jewelry, what I paid for, and when I sell, the value is much lesser. The way to make an intelligent investment in gold is to actually invest in sovereign gold bonds issued by the Reserve Bank of India, right? And what are the advantages? Firstly, this is pure 24 karat, 99.99% pure gold, right? That's held in the RBI vaults. When you invest over here, you get 2.5% extra interest that the government pays to you. First. Second, these bonds have a lock-in period of 5 years. You have to bear with that. And the maturity time for these bonds is 8. Over 8 years span, if you look at the gold prices, they have actually increased multifold. That capital gains that you make, government has made it completely tax-free, right? So you are able to save, on taxation. Third, it is completely affordable because you can invest as low as 1 gram of gold. So the recent tranche of sovereign gold bonds that happened was in this month itself, wherein the price was, I think, around 5,400-ish. And when you invest here through online routes, the government gives a 50 rupee as a discount. So 5,400 becomes 5,350, right? And yeah, the basic concept of investing in gold is actually to hedge against inflation and to protect and put in diversification to the portfolio. So investing in sovereign gold bonds any day is a better choice than investing in physical gold jewelry, unless it's for the family purposes. Now I'll cover the last asset, which is corporate fixed deposits. So we are all aware about fixed deposits from banks, right? Corporate fixed deposits is just a different avatar of this, which is issued not by banks, but deposit-taking NBFCs. I'll give you some examples. Bajaj Finance is a deposit-taking NBFC. Shriram Transport is a deposit-taking NBFC. They are authorized by RBI to take deposits and issue corporate deposit certificates to investors. Why should one consider them? Firstly, the returns on them are way better than the traditional bank FDs. Secondly, you can invest as low as 5,000 over here. It of course depends upon the corporate who is issuing it also, right? And you get a certificate which is a completely, an online certificate for your investment. The point to note over here is that corporate deposits do not come with any security, as against bank deposits, wherein you get a security of up to 5 lakh for your deposits. This is an example of Bajaj Finance corporate fixed deposit. It's AAA rated. 8.35% is the returns, max returns that you get for a 5-year holding, which is significantly higher than a traditional bank FD rates. So with that, I think I have been able to share something valuable with you for your portfolio diversification and for your needs of investing into fixed income assets. I'll just take 2 minutes to talk about our company, Goldenpi. So we began this journey in 2017. It's been a strong 6-year journey for us. We are a registered debt broker with SEBI, and we are a member of the Bombay Stock Exchange. We are also an online bond platform provider. That's as per the latest SEBI regulations which has come in. So any entity wanting to offer bonds as fixed income securities on an online platform needs to be a debt market broker and have that OBPP registration. On the platform, on any given day, we have around 4,000 crores worth of bonds, AAA to A-, which is readily available for investment. Until date, we have made investments over 2,000 crores. Actually, stands roughly around 300 crores as of date, right? And our core focus is to provide a very easy, smooth investment journey to investors for fixed income assets that I spoke of. With that, I come to the end of my presentation. Thank you very much, everybody, for giving me your time. I would like to take your questions now. Yes, please.
Hello, sir.
Hi.
Yeah, Abhijit sir, very nice presentation.
Thank you.
This is what you presented is for investment, right? How can we trade, particularly, and what platform will be better for trading purpose in bond market?
Got it. See, firstly, for trading, right, like I mentioned before, you can invest into bonds, you can take margin money. That's one aspect. Other than that, for your active trading into the bond market, right, you got to speak to institutional brokers, right, who focus on bond trading, right. So some of the examples would be like Trust. Trust is a very good big group that actually facilitates also, trading into securities like bonds and debentures. So you should, get in touch with these large institutions for your bond trading. Number one. Number two, on our platform as well, once you buy a bond, you always have the option to sell. So if you look at the option of actually trading, you can place an order for sell on our platform also, right? And we can facilitate your sell transactions. Yes, please.
Hello. Hello. Yeah. Here. Yeah. So, if you consider the US market,
There's a gentleman here. I'll take this question first, if you don't mind.
Not a problem. Yeah.
Sure.
So, Abhijit, if you consider the US market or global market, the bond and compared to the ETFs, so both goes hand in hand. So, assume that given a choice, I want to go for ETF or bond. What will you recommend, and what would be the reason for that?
Yeah. See, the biggest reason that the US market, right, prefers bond ETFs is the liquidity, right? In the bond market, like I mentioned, right, selling a bond outright in the market is difficult because bonds are not traded actively onto the exchanges. It's an OTC market product. Bond ETFs are freely traded onto the exchange. The biggest reason why you might want to consider it is for the sake of liquidity. But if you're looking at an HTM strategy, right, that you're okay to hold the bond till maturity, then from returns perspective, always a bond is better than a bond ETF.
And compared to the index ETF versus the bond ETF, what would be your preferred choice?
It's basically on the level of safety that you want to take, right? So bond ETF is going to be a very stable returns. Index ETF is another passively managed fund, right? But yeah, it's going to be a choppy kind of a return. If you're looking for higher returns, it's definitely index ETF.
Yeah, thank you. Yes.
Hello.
Yes, please.
So my question is regarding the transaction the transaction on buying NCDs, or if you're closing the position before the maturity.
So do I take your question into like two parts? Like
Yes.
transaction for NCD as an NCD IPO?
Yes.
And the second question is, how much time does it take if I want to sell the bond?
Yes.
Cool. So for the first question, NCD IPO, it's a very standard procedure, right? The corporate who is issuing that NCD opens up an allotment window, okay, subscription window, right? It's normally in the range of 15 to 20 days, right? Now it can get pre-closed as well if, it can get pre-closed in half a day also, right? For you as an investor, once you apply, right, you got to wait till the allotment date, which is 3 days post the closure date of that particular NCD IPO, right? So let's say, for example, I applied today and the issuance closure is on next Tuesday, right? Then I got to wait till Friday, right? at the end of which I'll get the allotment. My funds are deducted from my bank account and the units are credited to my demat. That's for the NCD IPO. It's exactly the same as in the equity IPO that you apply.
No, but is there a transaction cost to this?
No,
No.
there's no transaction cost. That's point number one. Point number two, your question was, now if I want to sell it in the secondary market, right, how much time does it take? That's a good question because liquidity is low in the secondary market, right, it becomes a function of whether you're getting the buyer, number one. Number two, even if you get the buyers, where the prices that they're offering is suiting you, right? So to answer to you simplistically, if you get a buyer, it gets executed on the same day. If it doesn't, it's basically you have to wait till you get the suitable price and a suitable buyer.
Like how significant is the spread when it comes to illiquid bonds?
Yeah. Once again, this depends upon when you purchase that bond and when you're selling it. Let's say, for example, I purchased an illiquid bond, as you say, a triple B rated bond, right, 6 months back, and the interest rate went down, right? I'm giving this scenario. My bond prices has gone up. So even if I'm going to sell it out and the seller is giving me a haircut on that current value, right, still I'll be making capital gains. However, let's say I bought a bond today and I'm wanting selling it in the next 7 days. For an illiquid bonds, you can consider there is no standard haircut that you have to take, the spread, but it can vary anywhere between 30 to 70 bips.
Sir,
Thank you.
You said lock-in period for sovereign gold bond is 5 years. 5 years.
5 years.
In secondary market, if we buy, there is no lock-in period. Secondary market.
If you're buying it from the exchange, right?
From second, I mean, this from
Yeah. See that lock-in period, right, actually comes in when you are applying for the sovereign gold bond in the primary market, right? Now, let's say I purchased it. I cannot sell it till 5 years. It becomes available in the secondary market only after 5 years. So when you go in the secondary market, that bond has already exceeded its 5-year period and it is now open for buying and selling.
Oh. Then tax exemption is not there in the secondary market.
It is there. It is there. Yeah. Let's say, because the bond has got a starting date, right? You bought it after the 5th year, but you're holding till the maturity. If you get capital gains, tax exemption.
Oh, okay. Then there is no difference between secondary market and primary market.
The difference is that, secondary market has got very low liquidity, number one. The primary market, definitely, there is no limit to the amount of gold to which you can subscribe, right? That's the first benefit. And number two, you don't get the discount on the secondary market as against the primary market, right?
Hi, sir.
I have run out of time actually, so
Please, if
I
you
got
can
to step
answer
down.
just one question. Here. Hello.
Yeah. Yes.
Yeah.
Yes.
Please. Did you, as you just said, there is low liquidity. That itself is putting my money at risk. I mean, if I want to get it out, I can't get it out. Do you agree, disagree?
There is low liquidity generally in the market, right? But then it also depends upon what kinds of bonds you're purchasing, number one. And number two, what is the institution through which you're looking to sell? An institution that can arrange for liquidity for you with a large pool of buyers, large pool of financial institutions can give you liquidity. Right?
Agreed. That being said, assuming I have bought the best of the company's bond,
You'll definitely get a liquidity.
so now if that company's price is falling in stock market, there is a direct impact on the bond price. Yes or no?
It would have. If the stock prices are falling, right? Not always it's strongly correlated because the stock price can fall because of a lot of global macroeconomic parameters also, right? Not necessarily the bond market price would also fall, right? But yeah, if the stock price is falling because of the fundamental nature of that company, that management is defaulting, right? The financials are not going well, right? Then the bond price is definitely going to take a hit.
Okay, and we do agree that bonds have come to almost default state and zero also for some good companies in the past.
Yeah, there has been default, definitely. Out of 16,000 tranches of bonds till date from 2016, if we take, 11 tranches have actually defaulted. But then the point to note over here is there is an Investor Grievance Protection Act and there is a NCLT. So each of these issuances that you see, right, are under NCLT for liquidation, and post that debt holders get the money.
Thank you.
Thanks. Thank you, ladies and gentlemen, for your time. It's been a pleasure speaking to you.